Obstacles to using a personal service company abroad. A personal service company is synonymous with an own limited company or a one-man limited company. An agency won't contract with a PSC. There should be no reason for your agency to refuse to sign a contract with a contractor's PSC. Using a PSC is normal when contractors are working in the UK and meets the requirements of the UK's Income Tax, Earnings and Pensions Act 2003, ITEPA 2003. The agency should insist that the contractor complies with the tax and social security law in the work country, as well as where the contractor is ordinarily resident, as demanded by the UK's Criminal Finances Act 2017. If the agency would like confirmation that this is the case, then ATA can give them this assurance formally in writing. It's called a letter of undertaking. It's not lawful to use a PSC when working abroad. No. Under the Treaty of Rome, it's a person's right to use their own company throughout the UK without discrimination. Is using a PSC to work abroad not splitting income? A contractor and his company are two separate legal entities. Provided the PSC receives all the income and pays the appropriate taxes, there is no splitting of income under any interpretation of tax law. The agency wants employment. Contractors have several legal options open to them while working abroad. These include being employed, setting up as a sole trader, setting up as a private limited company. Very often, recruitment businesses and their clients prefer an employed solution above all others to avoid the risk of deemed employment. The director of an own company is not classed as self-employed by HMRC. Instead, he's both owner and employee of the company. In most European countries that recognize the economic employer-employee relationship, the director of his PSC is its employee, which means that the director is in employment. It doesn't matter that the employer is a foreign employer. As we mentioned earlier, it's unlawful within the EU to prejudice a company if it's an EU company. Where is social security paid? The usual rule is that social security is paid in the work country, unless the worker has an A1 or certificate of coverage from the home country. Without this, it's necessary to pay local social charges on the local salary in the work country from the first day of the assignment. Where are income taxes paid? The usual rule is that under the double tax treaties in place between European countries, income tax is paid back home where the contractor is ordinarily resident. When the stay is for more than 183 days, the general rule is that tax is due in the work country from the start of the assignment. When working as a posted employee in the work country, the contractor receives a salary through the payroll. In the majority of states, income tax on wages needs to be withheld and paid to the tax office in the work country. That said, there are differences in domestic tax law that negate these rules. In most European countries, the employed director will be bound to pay tax in the work country irrespective of the length of stay, even though he may not become tax resident there. Where is corporation tax paid? The usual rule is that a company pays corporation tax where the central management and control are based. In the UK, HMRC presumes that UK corporation tax is payable in the UK. A company creates a fixed place of work abroad, either physically or because the seat of management has shifted there. Corporation tax then becomes due on the profit attributable to the business activities in the work country. Permanent establishment, fixed place of work. A permanent establishment is a fixed place of business or where central management and control are based, even temporarily. Where are dividends taxed? The UK does not have withholding dividend tax. Dividends are usually taxable in the hands of the recipient when and where the person is a tax resident. The rules and tax rates differ country to country. When a double tax agreement is in place, it may impose different tax rates for dividends earned in one country and taxed in another. These rates may be lower than the standard dividend tax rates. What about VAT? When a company creates a permanent establishment, it generally follows that the company has VAT taxable supplies in the work country, and so it needs to register for VAT in the work country. The VAT registration threshold varies from country to country, and in some EU states, the VAT threshold is nil. Otherwise, when billing from one EU country to another to a registered trader, the reverse charge provisions apply, so there is no need to charge VAT. Business expenses. When the director is working abroad as a posted employee, as an employee, the company can reimburse him for the overseas accommodation expenses. These expenses are tax deductible by the PSC. In case the PSC creates a permanent establishment in the work country, the laws of the land will determine the tax deductible business expenses, which vary around the world. Healthcare. If the contractor has cover for healthcare in his home country, the company can request an S1 certificate to grant entitlement to healthcare in the work country. Alternatively, the contractor can register for Social Security in the work country and claim medical benefits. Please contact us for more information or call one of our officers.